everybody. Welcome back. Welcome back to VC TV, the Venture Capital TV from La Token. My name is Sunny Monty. I'm the host and moderator of this episode to discuss what are VCs getting in return of investment. So VCs invest into startups. So what are they getting? What's the ROI? So we're going to discuss this at length with our speakers today. So let's have a quick round of introduction of our speakers today. Hello, everybody. How's everybody doing? Hi, Vandana, Harsh, Gary, welcome back.
Hey, Sonny, glad to be here.
Glad to be back.
Perfect.
Hello.
Absolutely. It's like the family hour. Kingsley is back. Gary is back. So it's like family hour again. So let's have a quick round of intro. This is a very interesting topic and also new for this episode. So I would like to know from you all, because you are the ones who invest. So what do you expect in return of your investment? Let's start with a quick round of intro. Vandana.
Thank you, Sunny. So first of all, I want to thank the entire team of La Token VC TV for arranging these episodes. It helps people get connected, globally, and there are lots of insights to share. I myself learn a lot from the VC TV shows over here. Coming to the introduction about myself, I was in Singapore and Jakarta for 15 years in investment banking. And I had my own family office in Singapore and Jakarta. I worked as an investment banker and advisor to family offices and angel investors in Jakarta, Indonesia, helping startups from a diverse background from fintech, B2B tech, all the way to consumer startups. I was raising funds for them and providing them with a wide range of services, just as Convanto does today. After 15 years of staying in Singapore and Jakarta, I came back to India. I did investments for a bit and then returned to advisory. That is when Convanto was founded. Today, Convanto is one of the most well-known boutique investment banks in India, led by a female founder. I'm also a venture advisor with Loyal VC, the INSEAD-led Canadian VC Fund, having a core portfolio of over 160 investments in more than 35 countries. I'm also a partner with GST Venture Studios, a Silicon Valley-based venture builder. And over the years, I've arranged funding for startups and growth stage companies in diverse sectors like edtech, fintech, consumer, B2C, and B2B, agri-tech, health tech, food tech, disruptive and deep tech, as well as non-tech sectors. And I would recommend all of you to have a look at my website for the wonderful testimonials written by my clients. This month, I've been selected as one of the top 10 women leaders in Wealth Management 2021. Apart from this, my brand is also selected as a top 10 brand in women entrepreneurs by a magazine called Global Hues. And my expert opinion is often sought by leading business news channels and publications like VCTV, Business World, and I've participated in 160 plus talks all over the world. You can easily see them through the YouTube and VCTV streaming sites. I'm connected with 300 plus investors globally, and we pick up global deals. We are sector agnostic. Typically, we do a $1 million to $25 million. And once again, thank you for having me here.
Awesome. Fantastic, Vandana, for your achievements. Really, congratulations and welcome back. Great to have you always. Okay. Next, I have Kingsley. Hi, Kingsley. How are you today? You're mute, Kingsley.
Hello, how are you, Sonny? How are you doing?
I am very good. I'm very good. Thank you. I've recovered. I'm very good. Thank you.
That's good. It's good to be back on the family hour with everyone we know here. And I want to congratulate Tulani for her selection as one of the best female entrepreneurs. Happy to see that the women we are debating and talking with are going to high places. Congratulations on that. It's good to see her, Hash, I think, right? Yes. And see Gary, GSD is here. And I'm really happy. My name is Kingsley Kobayashi. I'm a senior entrepreneur. I am the founder of Kobayashi Group, a serial investor in different aspect of life, whether it's fintech, is traditional tech, finance, is agri-tech, is just name it. There is no bad project. Every project is a good project until it is proven otherwise. So we invest our money in businesses that will yield profit, and I'm glad to be here today.
Thank you. Thank you so much, Kingsley, to be a part of the show today. It's a very important topic, and I myself, with the viewers, would like to know more about all this, from you speakers today. So thank you. And Harsh, over to you. How are you, Harsh?
Hey Sony, glad to be back. Doing great as always, and glad to have a family and Gary, Kingsley, and Vandana here. So, just a short intro about myself. I'm a venture partner with our ventures. Also work independently, helping startups raise funds as well as grow their business. Currently, we typically take deals all the way from 500k all the way up to 15 million, whether it be debt or equity. I help in very alternative forms of fundraising as well, so that founders can retain their equity without losing too much dilution while they're kind of scaling up, right? So that
Yeah.
those are the couple things I do. Additionally, I also help them with strategic growth collaborations as well as growth partnerships, and helping them streamline their entire marketing fund, so that the automated business can take care of itself. Currently, I'm associated with two family offices and industry conglomerates, and I'm actively looking for startups in the prop tech and real estate tech space, so that if any startups are looking to raise funds in that, I'll be happy to connect with them.
Oh, wow. That's good to know that you are looking for startups in the space. Great that you mentioned. Thank you so much, Harsh.
Thank you so much,
Okay,
Sonia.
last but not least, Gary. Hi, Gary. Welcome back.
Hello. Hi, everybody. Great to be here and see some familiar smiling faces and friends. My name's Gary Fowler and love artificial intelligence, quantum computing, cybersecurity. I'm a serial entrepreneur. I've done 17 companies and an IPO on NASDAQ. Been involved in building $2 billion companies. I was on the original management team of Click Software, sold to Salesforce for 1.35 billion, and also Eva.ai. Um, have been doing a lot of speaking engagements and written 161 articles in the last 18 months. Actually, speak at the United Nations as part of their General Assembly on October 1st. It's my second speech at the UN. This one's my last one was on computer vision as a tool to combat violent extremism and terrorism. And this one is going to be about how to make the world a better place using technology. So love that stuff. Why they want a farm boy to come up and do it is beyond me, but I am doing it. So we also have GSD Labs. I'm the CEO, president, co-founder of GSD. We have GSD Labs, which in this cohort has 18 companies from around the world. We're currently working in now 31 countries. So it's really good. We're trying to make a little dent in the universe because just like VCTV came on board about 2 years ago, we also believe that digital transformation is upon us, and we need to be able to expand our presence because intellectual capacity is evenly spread, but opportunities aren't.
Great. Thank you so much, Gary, for being a part of this show today. And welcome back. We are all done with the introductions of the panelists today. It's a very important topic. I would really want to know from you all. So let's just start with the first opening question. I would like to know your remarks on that. So what are the different stages of investments are there? And what do VCs consider a good rate of return? So different stages in an investment, and what is a good rate of return as per industry standard that VCs to consider? I'm going to start with Gary.
Yeah, so it really depends. Every VC sets a target. So one VC on a seed A may say that, it's 15x. But look at this, Sonny. If you look at it, early stage investments, good return might be 2.5x. Why is that? Because 9 out of 10 companies fail, depending on what stage they're in, if they have revenue or don't have revenue. But then, imagine the picture. You've got 4 good deals, and alongside that went 10x, and then alongside 20 deals that went belly up. So what we got to do as investors is look for companies that have the right stuff. Look for the team. Look for a company that they've gotten product market fit. When I raised $7 million for EVA in my seed round, they looked at the team, which having a billionaire as a partner. I mean, they're going to look at who your advisors are, who your board of directors are, what kind of company you have you had success in the past or not? It's a big, it's about trust and the probability of success. So the VCs that are out there are looking at their idea is to be able to maximize a return. Could be 2.5x, as I said. You got a lot of deals. One Series A fund could be 8x. They make the determination how much risk and what stage of companies want to invest in. Now, get this. I mean, one of the things you want to do is if you have these early stage companies, you're in the game early and you got a lot more upside. The bad news is the probability of failure is a lot higher, right?
Yeah.
And as risk starts to go down, the valuations start to go up.
Yeah. So do you comment upon these numbers upfront, or is it something that keeps on changing?
I mean, it changes all the time based on the market, based on, AI companies were generally 15 to 20x forecasted revenue forward, right? So because it depends on the space, it changes all the time. So you got to look at what the market's willing to bear at that particular time. Right. And how much belief. So, for instance, with EVA, about a year and a half, 2 years in it, I had a range of 40 million to 529 million, I believe. I have to look at when they were looking at some people were interested in buying us. So I had that big of a range in terms of what the company's worth, because they can't put their finger on, what's going to happen a year from now. They bet on the team, et cetera. So a lot of it's based on negotiation too, by the way. So on what the valuation is of the company. Then the situation is what the venture capitalist is looking to get out of that particular company. I mean, what targets do they have? How conservative or how aggressive they are for it.
Interesting. Thank you, Gary, for those opening remarks. Next, I'd like to go with Harsh.
Hi. So Gary kind of gave the rough ballpark, right, around 2.5. Ideally, most VC funds look at a return of 3x is considered like a benchmark, right? If they can give 3x returns to the LPs, that's truly like the benchmark. But on an average, what the average we've seen is between 2.5 to 3 range, right? So the idea is to find as many good startups as possible and kind of support them, right? Unfortunately, the current trend that we're looking at and the way the last 2 years have been, it's been slightly more difficult, especially at the earlier stages. In the latter stages, where the private equities get involved, 15 million, 20 million raises and beyond, it's been extremely easy to raise funds. In fact, they are kind of being overthrown with money, especially if you look at the case with India. The amount of investment that has happened at 50 million, 100 million, it's been extremely high. Compared to that, at the earlier stage, the seed level or the pre-series A, the series A level, the number of deals have kind of gotten down. That is because of the uncertainty, right? And they're not the VCs, they're not confident of that many deals where they can kind of give that 3x return. So that is where the current dilemma is, at least for the early stage startups at this moment.
That's the dilemma. That's good to know. I'll be asking a question after I go with first round with this. Thank you, Harsh, for your contribution. Vandana?
Sure.
So, there are 5 stages in which a VC comes in. The first one is a seed capital. Now, the description of a seed is appropriate since it suggests that money will, fuel a startup's growth down the road. And at this point, the leaders of a startup may not have any commercially available product yet, and are mostly likely to focus on convincing investors why their ideas are worthy of VC support. Now, seed funding rounds are typically small and are channeled towards research and development of an initial product. The money may also be used for conducting market research or expanding the team. Then comes the second one, which is a startup capital. This stage is similar to the seed stage, with initial market analysis conducted and business plans in place. Companies look to begin marketing and advertising the product and acquiring customers. Organizations at this stage likely to have at least a sample product available, VC funding may be diverted to acquiring more management personnel, fine-tuning the product or service, or conducting additional research. Then comes the third stage, that is the early stage, or the first stage, or the second stage capital, but it's called early stage. Though sometimes called first stage, this stage only comes after the seed and startup ones in most cases. Now, funding received at this stage will often go towards manufacturing and production facilities, sales, and more marketing. And the amount invested here may be significantly higher than during prior stages. At this point, the company may also be moving towards profitability as it pushes its products and advertisements to a wider audience. Then comes the stage 4, expansion stage, or the it is also called the second or third stage capital, where in this the growth is often exponential by this stage, and according to VC funding serves more fuel for the fire, enabling the expansion to additional markets. Example, other cities or countries, and diversification and differentiation of product lines. Now, with a commercially available product, a startup at this stage should be taking in ample revenue, if not profit. And many companies that get expansion funding may have been in the business for 2 or 3 years. And VC funding serves as more fuel for the fire, enabling expansion to additional markets and diversification and differentiation of product lines in this stage. Then comes the stage 5, which is also called like a bridge or a pre-public stage. After reaching this juncture, the company may also be looking to go public, given that its products and services have found suitable tractions. Fund received here can be used for activities such as mergers and acquisitions, price reductions, other measures to drive out competitors, financing the steps towards an initial public offering. If all goes well, investors may sell their shares and end their engagement with the company having made a healthy return. Now, many tech IPOs like Facebook, Twitter, and Yelp were only possible after years of VC funding that fueled the user and revenue growth. There's a saying that there's no such thing as free lunch, and VC funding, of free apps and services is a good case in that point. We are also seeing now Zomato, which was a loss-making company, has reached the IPO, as you see. And standard, what the VC takes is between 10 to 15% equity in the company. But again, depends from startup to startup, team to team, at what stage they are. It can go to 20 also. In some stages, I've seen people taking 50% also. So again, it depends on what case comes, what technology comes, and what is it at that point of discussion.
Interesting with the numbers in terms of equity percentage.
Yeah.
Thank you, Vandana, for nicely explaining the different stages and the returns. Thank you.
Yes, sorry, can you see me?
Kingsley, we can hear you, but we can't see you. Is it your camera is not on, switched on?
Hello, Sunny.
We can hear you. Okay, we have lost Kingsley right now. Let him just come back. Okay, that's great. So we have covered the opening remarks in terms of different stages and the returns and what the VCs are looking, and different industries obviously treated differently. Good to know all this. So once obviously that process has gone through and the contract has been concluded, and VCs have finally made the decision to go ahead with the investment. So what do VCs expect to get out of that startup once they have committed to invest in? So basically, I want to know, like, what exactly happens from day one. Now Gary has decided, GST Ventures has decided, okay, I'm going to invest in this AI based startup. and this is obviously in a Series A stage because you do early stage investment mostly. So what happens from day one after that is concluded? Gary, over to you.
Yeah. So, I mean, what happens day one, from my perspective, we want to develop a relationship and become, we want to become part of the board of directors, depending on what investment level we have in that company. We want to help them. It's like getting married, right? You want to make sure that you're part of that team and you're helping the startup to give them the greatest chance to be able to succeed. And what the greatest gift that entrepreneurs can have from an investor is somebody that's on the board that really can enhance their network. Then can be like a senior advisor to give them information to be able to how to pivot their company in the right circumstances. One that's it's not all about the money. It's how to be able to build the opportunity, really to build the company up. So what we're doing is we're coming into the company and really to assist that company in all kinds of ways, whether it's specific contacts for hiring, other places where they might be able to raise funds, potential partnerships because of relationships we have, whatever we can do to help that company grow. It's really a 360-degree view. From my perspective, not everybody takes the same role. We believe that we, at a level of GSD, we take operational roles in those companies many times. So I'll take a chairman role. My partner will take a CRO role. Other members of the team will fill in to give them the greatest chance. But I mean, think about it. The first thing that somebody's going to look at in that company, who are their advisors? Who are their advisory board? So you just want to build it out so when people look at it, that they have enough publications out there, that they're visible to the community. Because the first thing people do when they look at that company, let's say there's a partner and I've invested in them, is they're going to Google the name. They're going to say, who is this company? And there's nothing out there. It gets them real nervous. And it's hard these days because many of the deals are being done with ever meeting people now.
Yeah. So Gary, you rightly pointed out that's how GST ventures work. But I have heard stories where people say that VCs just come into play. They just put in the money, the dollars. They don't care about anything else. But is it changing?
Well, but that's not smart money, Sonny, because if you take that money because you have to have it, I've also heard the opposite. I'll tell you a direct situation I heard. The company we were working with, and the company had taken a $250,000 investment from an ultra high net worth individual.
Mm-hmm.
Now, that ultra high net worth individual heard that we were coming in to work with the company. So all of a sudden he thinks his money's worth a lot more money. So what's he tell the company? Now, this is dumb money. This is how it works. He said to them, I want to get my original 250 back plus another 250 now, right? And I want to have 5% of the U.S. operations. It's crazy. You know what I mean? They were going back and forth because the person was dumb. It's dumb money. You got to be careful with dumb money because not good things can happen. It can really tie your business up. They'll get lawyers involved, and it just is a bad thing. You need to have people just like Harsh and my friend Kingsley and Vandana that can come out and give you advice to be able to help you grow your business. Because if not, some people get desperate and they take the money just because they have no other choice. But then the situation, they end up putting their company out of business, or they sell too much of their company and you end up working for them instead of being an owner of the company. You end up being an employee.
Wow. So this is a very good point. This is called dumb money. So founders, entrepreneurs out there, just be careful about this money. I mean, obviously everybody needs, as a founder, need the money, but you need more than money as well, right?
Yeah.
So nicely explained, Gary, with that example use case. Thank you so much. Kingsley, you back now. Sorry, would you like to take the first question?
Yeah, can you ask the first question again, please?
So today's topic is so VCs, what do they get in return? So the question leading to that point is, what are different stages of investments in a VC funding, and what do VC consider a good rate of return? Everybody had given a different percentage. So as per you, what's a good considered a good rate of return?
Well, the percentage is pretty clear from listening to everybody is between 25 and 35%. But if you get 20%, in my view, I think that is okay. And why is this percentage very high? Is because they have higher risk at the beginning. The company may fail, it may succeed, they don't know. So they are taking a higher risk. And you also have to understand that this is they also raise money from different ways. They raise money through family offices, high net worth individuals, and this institutional money. And these people need to be also serviced. They have to also get back returns. So people think, oh, 25%, 35% is very high. I don't think it's high because they are taking a risk and they are putting their money in. And like Gary said before, it is even better to have the VC put the money to be part of the company. It gives it credibility. It gives it authenticity. It shows that they are willing to help it grow. Just dumping your money there and thinking, oh, when I make the money, it's okay. If I don't make money, it's okay. It's not the attitude that a founder wants to have. A founder wants to have people that will work with them step by step, somebody that will help them grow together. So if you are just looking for money and you're not looking for those that will help you grow, you already have a problem. So that being said, 25%, 20%, 10%, it depends on the product. What are they selling? What is the management
Right.
team? What is the advisory board? Who are they working with? What is their target market? So there's a lot of things to look into when you are trying to make a decision as a VC to invest. And also a lot of things to look into when you are looking for a VC as a founder or a startup. A startup has to do a lot of research. They have to do a lot of deck and explanation to make the investors understand. And once the VC understand this, the VC is also able to explain to their other investors who are under them, and then they put the money in. And once they put the money in, it is that is when the work starts for a good VC company, because that is where you have the general type of the VCs, and then you have the long term. Those you have the foot soldiers. You call them foot soldiers. Those who actually go out there to see, oh, what are they doing? Are they really working? Is the factory actually there? They have the right management to make this work. And then you have the long-term investors who will be putting money as it grows. Like Charlie said, you have stage 1, stage 2, stage 3. Yes, you need investors for the stage 1. You need that kind of investor for stage 2. You need investor for stage 3. But you need to provide paperwork for these stages to make sure that you are growing. You have to provide analysis of what you have done so far. You have to provide, reports on what you are doing with the company, what you are doing with the investors, what you are doing with the management team. Okay, this guy was not good. Why did you change him? Why did you not put this guy here to run it? So if I was looking for an AI advisory person, I would go for Gary. If I was looking for somebody else, the people that you put on the team are very important. So that will show whether you are going to grow or you are going to just fail. You know that from the startup. So what businesses are looking for? They are looking for, yes, high ROI, which is high return on investment, but they are also comfortable with a lower investment, which is stable at the long run, because they are looking at 3-4 years, looking at 7 to 8 years for their return, but they actually get the money back between 10 and 12 years. So they are long-term players. They are not short-term players. So if they are long-term players, they're going to be with you for a long time. And the question of equity also comes in. Are you giving part of the equity to the ordinary investors, or are you giving part of the equity to the VCs? Does that now make you a founder or make you a worker, like Gary actually said? Because you don't want to end up not owning your company. You want to be able to negotiate in a way that you own your company, but you have investors in your company. But some people sell themselves short. There are companies, I don't want to mention names, that have sold for 200 billion, 250 billion. If they have waited 3 weeks, they will sell for 1 billion. So, but it is not their fault that they sold at the price. The pressure from the investors was too high. So they had no choice but to sell to be able to pay back the investors right away. So you also need investors who are patient, who are resilient, who are not short of money, that they're going to be asking you money when you need to grow. These are some of the steps I think you need to look at. There's more, but let's stop there for now.
Yeah, absolutely. What I gather is that there is no one rule of thumb, like how a VC and a startup founder works. It's rightly said, like what's coming out from this panel. It's like a marriage; you have to find the fit, right? I mean, who who becomes the owner, who becomes the employee, or like Gary, they would move into a advisory position, move into the board of members, but sometimes VCs are hands off, right? Sometimes they think about short term, some think about long term. So yeah, thank you for sharing those insights. Coming over to Harsh, the second question I had. Okay, now that we have this investment, we have this contract concluded. Like we have found a fit. So it's the startup founder has found that investor. So what happens after that? What real life use cases can you share with examples?
So essentially, it will depend from each VC to each VC, right? We like to generalize, venture capitalists are like this, venture capitalists are like that, but it's extremely individual because each and every VC has their own approach of working, right? That's why it's extremely important to see it at an individual level. Even when you are raising funds from the VC, the way you're interacting with them, I understand that you are in a bit of a desperation to raise funds. At the same time, you need to kind of understand how they're operating with their portfolio startups, right? A good approach would be to kind of reach out to their portfolio companies and try to have a word with them and figure out how their VC operates, right? That could be a good way to get some sort of background checks. The VC is going to be doing a background check on the founder. The founder should do the same for the VC as well, to kind of understand how the VC is operating, because that is kind of going to give you an insight what the next 1 or 2 years are going to look like. Some
Right.
generally in the early stage, what I have noticed is most of the VCs, especially the smaller VCs, the micro VCs as we call them, they like to help as much as they can because they have taken the most amount of risk, right? These are the kind of VCs which put like 250K or 500K or $1 million. Typically, how Vicom or Techstar or these guys operates. These guys tend to be very hands-on. They have a lot of ecosystem which they can use, and they can provide kind of kind of propel the startup towards success. At the same time, on the other hand, if you look at on the higher end of the spectrum, the involvement goes less and it becomes more of a financial transaction, especially when it's like a 50 million or 100 million kind of a deal. At that point of time, when private equity players kind of jump in, it's more of a financial deal rather than a support and that kind of stuff, right? So it's extremely important to understand and gauge each and every VC based on the negotiation that you have, right? And you need to take you need to take that very seriously as well. In fact, because what typically is going to happen is once you have VC money in, right now, until you have VC money in place, it is still your company, 100% is you. You still have
Yeah.
some sort of flexibility and some sort of leeway. But once the VC money comes in, you cannot ease up. You have to put in 16 hours, 16-hour working hours, 14-hour working hours, and you have to grow on an annual basis at least 4x to 5x. Because if that kind of growth is not there, you're going to be in serious trouble, because there are a lot of clauses in the term sheet as well, where since the valuation cannot be determined, they put some clauses in the term sheet as well to kind of ensure that the a reasonable amount can be taken care of. We cannot get into much details over here, but the idea is it's extremely important when you take that VC money, you understand how the VC is operating, the kind of structures that they have, and you need to be prepared for the kind of pressures involved. Because if a VC is putting 500,000 to 1 million in your company, you better be sure that they're going to be following up with you at least every fortnight, and kind of ensure that you're on the right track and the right things are going to be met. Even the business plan, a lot of times, we ask for 3 year 5 year projections. The idea is not, obviously we understand there are going to be a lot of variabilities, but the idea is to see, has the founder kind of thought through those projections, or is he randomly adding those numbers? And some founders naively kind of say us, yeah, I can just put random numbers on the Excel, but it's not going to work, right? You say that to a VC, and that's a scratch immediately at that point itself. Because if you can't even put the effort to put a focus on that 5 year plan, and you can't take the time towards that, and you're simply telling me it's just a number on an Excel sheet, what commitment will you have towards growing your business? So that's why it's extremely important to kind of take each and everything very seriously, because each and every step, the VC is looking for 100 reasons, for you to say no. VC has 100 reasons to say no to the company, and they're looking for only one. You have to have 100 right things, and one wrong thing could take the deal away completely, right? That's why it's extremely important to be extremely prudent when you're reaching out to them.
Well, one thing you mentioned that about is the more the value of the funding is, it becomes a financial transaction as opposed to being, getting that support. But do you think they need that support at that stage when they're looking for that amount of money?
Of course, because even if you're at a 50 million, 100 million kind of stage, right? At that stage, you're typically looking at geographical expansion, right? So if suppose we have a company in India and they're looking to raise 50, 100 million, the idea would be to take it from a VC or a PE which has geographical presence in that country, right? So that they can kind of give us an easy way of entry. Because what typically tends to happen is if you're expanding into a new country, you don't have those on the feed people who can give you that kind of information, who can give you that kind of on the ground feedback, which you need desperately at that point of level when you're expanding, right? So that is where at the higher level that becomes extremely important. So some PEs do, some PEs don't. Some of them look at it purely like a financial transaction, but as Gary GSD does, right? The essence of GSD is that people can expand into the US, because they can help you with the local thing. That's what needs to happen at those higher stage, looking at geographical expansion, and that's what the focus should be. But generally, it unfortunately doesn't happen as often as it should.
Great. Thank you, Harsh, for sharing your insights. Thank you. Vandana, over to you now.
So, when a company is given a term sheet, there are a few exit options that are given. Now, the exit options are very few. The founders will aim to give exit to investors, but the first option is to give exit to the investors through an IPO, which will be approximately in 5 years, getting the company shares listed on a stock exchange, so that with the liquidity that is coming through trading of shares, the investor can sell his shares anytime, partially or fully. Then the second is, if IPO is not possible, then the company should appoint an independent valuer of the shares and find a third party investor who will buy the shares from the original investor. And the new investor should buy shares at a price which will give the required IRR, the internal rate of return, to the original investor. The IRR asked is usually 20 to 25%. Now, if the second option is not possible, then the company should buy back the shares from the original investor by giving him the required IRR. And if the third option is not possible, then the founder should buy back the equity from the original founder by giving him the required RRR. If all the above is not possible, then the company should look for strategic partner, one who buys a big stake in the business as a strategic investor and not as a financial investor, hence gives exit to the original investor. Right. Now, there's a lot of advantage when VC funding. One is that you get large amount of capital raised with which you can hire good teams. You get a good marketing team from the VCs. You get a good technology team. They come in with a large network. So, when it's a breaking news that this company is VC funded, itself the company gets a lot of value in the market. So, it's not a simple task, but once you get VC funded, there's a lot more leadership advice also that is available. So I think there's a lot of advantage to getting VC funded, and VCs are very professionals. They are, they are in and out of the investors market. They also come in with second, third, fourth rounds if they really like the company. So there's a lot of support that one gets through a VC fund.
Right. Thank you so much. Coming over to Vandana's point, she mentioned about exit options. Like I was supposed to come to that question, but thank you for sharing that. So let's just hear from others. What are the different exit options available there, VC sort of funding. Gary, and which one do you prefer? Which one do you prefer the most?
Well, I mean, it really depends on the company, right? So obviously, if you have the right kind of partnerships, for instance, with one of my companies, we got approached by some of the top, Click Software was purchased by Salesforce. A lot of it's about the relationships, like I said, with the advisory board, et cetera. What I like, I mean, obviously, if you're doing an IPO and the question is to be able to get more money into the company to be able to build it, obviously, the founders of the company are going to be are going to make a lot of money during the IPO. It's incredible when you do it. We did ours on NASDAQ, and ringing the bell up in New York was interesting to see a company progress from a little company of 8 or 9 people to a company that's listed on NASDAQ is a phenomenal situation. I remember the day it happened, and I was coordinating all the press and that kind of thing. It was amazing. But what I prefer from my standpoint is, whatever makes the most sense to be able to keep the company on track, to be able to grow, and to maximize the opportunity for the shareholders so that it's a win-win. The one thing you don't want to do, Sonny, is sell too early. But it's just like Facebook was, I think it was Yahoo was trying to buy them. One of the companies was trying to purchase a Facebook, and they decided, and I think Google too, and they decided not to sell. What was the best move they ever made? You got to have real firm belief in what your future is. And as investors in a company, you have to believe that it's the right time and you're not going to leave money on the table. So I personally, I like the idea of an IPO. From my standpoint, it's not truly an exit. You're just, raising more capital, but it helps that company grow. I also like, mergers and acquisitions with the right kind of company. And I've had discussions with many of them, Atlassian, Salesforce, Dropbox, you name it. But you have to make sure that the company's in the right position. You got, as I said, it's really important to make sure you have the visibility today, because the first thing they're going to do is they're just going to start to due diligence to figure out who you are. Are you an industry expert? Do people recognize your name? Little things. What's your advisory board look like? And do you have revenue, and how much revenue do you have? The one thing that happens sometimes, if you don't have enough revenue, they do what's called where they actually pay you for your employees. What's it called? Harsh, I forget the name of it. It's not the equity. It's
Which one?
It's a transaction where they buy you for your employees. They'll pay like $500,000. I forget the name of it. But
so when you don't have enough revenue, Gary is asking what happens, how they evaluate.
There's a name for it. I just forgot.
CCPS?
No,
Convertible notes?
It's when they come into your company.
Discounted cash flow?
It's no. It's when a company comes in and looks at your company, but they're paying you like $500,000 for your employees. They just need additional employees, and essentially they're buying the employees. There's a name for it. I just forget it.
Working capital financing.
No, it's where they're. No, we're getting close.
Wow, that's good.
But anyhow, what happens? I've had those discussions, and if you don't have enough revenue, they're buying. So, for instance, if you have a 10-person company, they're looking at you and say, "Okay, listen, I'll give you $5 million for your company," right? And they have to stay on board for 2 years.
That's the equity hire.
Equity hire, that's right. And so the equity hire, and you got to be careful, because you're not really, realizing the full potential of your company, and you'll be selling it too low. And what happens sometimes, founders get nervous, and they see the first deal and they want to take it. And you got to be really careful. If you really believe in your company, you got to move it forward. You're just essentially starting to work for somebody else. If you do that, an equity hire, you're just becoming somebody's employee. And I remember one time with my billionaire partner, David, and if you're listening, David Zhang, he was talking to me. He said, listen, I was joking with him. I said, because he was my partner in the company and he was a CTO of the company. And I said, David, if they buy the company, they're going to want you. You got a PhD in AI, and you're going to be the guy that sits in the cafeteria. What they say is many times is that you'll be sitting in the roof, and like at Facebook, you'll be on the roof in the dining facility, sitting there all day long for 2 years, right? and
Right.
so what happens is you want to make sure that it's the right kind of deal, that you're getting the maximum value for your company. Some companies may be a good deal, but others, you might want to wait, and you might want to sell it once you've got your revenue in and you start to really maximize the value of the company.
So what if a founder is struggling to get the revenue in?
Well, then maybe they should hire some new people, or they should bring in some additional people. Many times what happens, Sonny, is they don't have the sales, marketing, business development expertise in their technical founders, like almost 70% of the time. And they don't want to listen. They believe the product will sell themselves, that they don't need salespeople, like it's like voodoo. And that if they bring them in, they're unnecessary. They don't really do anything. What does marketing really do for my business? They don't get it. It's critically important. And so if you look at it, the founders that do get it are either really smart and understand it, or they hire the right kind of people to help them.
Perfect. Thank you, Gary. Thanks a
Sure.
lot. Ash, over to you.
So the last point which Gary made hit right home, right? So there is actually a joke among Silicon Valley founders that why do you need a sales or a marketing guy up front, in the earlier stages of the company? They say,
Yeah.
then who will bring us coffee? So that is
What?
kind of who will bring coffee for us?
Oh, okay.
So that's what they think the role of a business guy or a sales and marketing guy in the beginning is. So a lot of these techies, at the early stage, they kind of feel, the marketing guy or a sales guy is not really important. Then they go, a few rounds, they see, and they're not getting traction. Some still don't get it, some get it down the line, but this problem always remains. So that is why it's extremely vital to understand the importance of sales and marketing. And that's exactly kind of where I tend to come in, right? But coming back to the earlier point regarding acqui-hires, which Gary was mentioning, the problem which typically tends to happen is startups, and when they're looking to raise funds, they have this extremely high valuation kind of mindsets, right? Then there needs to be some sort of logic, based on the revenues that you're doing right now. You can look at a 10x or a 15x or a 20x multiple, which sort of kind of makes sense. If you're expecting a ridiculously high valuation, what tends to happen is not only will you get a lot more rejections, next time you kind of burn the bridge with the VC, because next time you kind of go back to that VC, what might happen is, now that you've come to your senses, now I'm going to lowball you with a lowball offer. So
Wow.
typically it tends to come to bite back in their butt, because initially they wanted a very high valuation. And the problem with that approach is, I typically tend to feel you need to have a very methodical approach of fundraising. And if you look at too high a valuation upfront, it's kind of going to be damaging to you, not just for the current fundraise, but even for the future fundraise. Because what's going to happen is, if by chance some VC agrees to that high valuation, they are going to put some clauses in the term sheet which you may not realize right now. But when the actual liquidity event happens, whether during an IPO or an acqui-hire or a SPAC or whatever might be the case, you will realize that even though the company is getting the windfall returns, much of that is going to the VC and the PE, and you are not getting much in your hands. So that is why chasing too high a valuation too early is extremely dangerous, and startups need to be extremely careful about doing that as well.
How to do the correct valuations? What's the
Sorry?
formula? How to
No,
do the
so
correct valuation?
No, so there is no formula, right? The thing is, this is one more step, right? Most of these tech founders, they are very system focused, and they want to see predictable patterns and predictable formulas, right? But if you look at the entire startup journey by itself, there is nothing standard about it, right? Because the product like that doesn't exist. No one really knows how it's gonna go. That's why even the fundraising process, they need to be comfortable with the variability, with the uncertainty, with the negotiation process. It's going to be extremely variable and dynamic, right? I was just kind of discussing that last Friday with a startup. I'm helping them to raise funds. They were trying to, he was asking me the same question again and again in different ways. What kind of valuation should I get? What kind
Right.
of debt I should get?
This
Or,
is very
how much?
important, Harsh. Very key, right?
Absolutely, absolutely. So
Yeah.
from there, they're trying to ask the same question through different angles. What kind of equity will I get? What kind of debt I will get? What kind of interest rates I will get, etc., etc. But I'm
Yeah.
saying this is all up to negotiation, right? You can't expect it to be standardized just like a technology product. You need to be comfortable with that kind of variability, with that uncertainty. If you don't have that confidence level, it could kind of hurt you in the longer run. That's why it's extremely important to be extremely flexible and understand that everything is negotiable. There is no standard rule over here. It's all come down to when you sit on the table, what's going to happen. Even if you get the valuation, then the term sheet is another element where discussion can get completely long drawn out, and sometimes the deals fall off over there.
Right. Wow. Thank you so much, Harsh, for sharing those insights with the entrepreneurs and founders who are watching us today. Kingsley, would you like to add to what Gary and Harsh just said about exit
Yes,
options?
don't mind the name. My phone got too hot, so I'm using my wife's phone now. So probably better. And just to chip in from what Sonny said before, that it's like marriage. Marriage itself is not an achievement; it's a responsibility. A lot of people forget that it is an achievement. You get all the congratulations, and you think it's an achievement. No, it's a responsibility. The same applies to any founder that is looking for money. The money you have got is not your money, it's a responsibility. You have to be accountable for that money. So a lot of founders fail because once they get the money, they believe it becomes their money. They're no longer accountable for that money. No, you are accountable for every penny that you are getting. And you're transparent. If you are transparent enough to show how you are using the money, a lot of other VCs will be willing to put money into your company, into your product. The truth right now is that it is easier to get money from VCs than from individuals, because with the COVID pandemic, VCs have become the go-to area for startups and other people because they have the ability to gather money from people if they have the how do I call it? The integrity that they deserve to get that together. And there is what we call in Japan as jikomazoku. Jikomazoku is getting satisfied on the way. You are not there yet, but you already believe you are there. You already believe you are successful. You cannot stop being hungry as a founder. You cannot stop being hungry as an investor too. So you have to be able to work together to understand each other. You have to accommodate change. For example, there's a lot of people that have to change the way they do business due to the COVID pandemic in the past 2 years. So you have to give rooms to be able to switch your business or twitch your business a little bit. You have to be able to get advice from those that know better than you. Don't just think you are the think tank, you know everything about this business. No, you need a versatile advisory board that will advise you on the next step to take. If it's AI, if it's robotics, if it's your team management, if it is your product has to change a little bit. Maybe it's a product, the taste is bad, or it smells kind of, you may not know it because you are the one making it. So all these small changes, you have to give room for it, for your advisory board, for your team members, for whoever is with you to advise you and make a change to make it better. So it's all about understanding. And I personally believe that, like Sonny said, brought marriage up. Marriage is all about understanding. You have to understand how it works. You have to be perseverance. You have to tolerate. If you don't do this, it's not going to work. So the business factor of going to look for money is the same. You have to be able to explain what is your business about. You have to know your business. You have to know your product. You have to be able to say, okay, this is so-and-so person who is representing me in America, and this is what he does. And they have to be able to Google that person, find out, ask questions, and they see who he is. Okay, this is somebody I have from India. What does he do? So these are all simple things that founders have to look at. And VCs are looking for higher ROIs always, but it's all about negotiation. At the long run, you don't get what you deserve, you get what you negotiate.
Absolutely. I think both Harsh and Kingsley, thank you so much for stressing on that point. It's all about negotiations. Thank you so much. So let's just wrap up the show with some good closing remarks from each of you. Harsh, over to you with your closing thoughts.
Absolutely. So a lot of founders, definitely VC money is a huge boon, which we have seen over the last 2 decades. At the same time, take it with a pinch of salt and be extremely careful that are you prepared for it. It's extremely important that because you realize because once the VC money comes in, you're accountable to provide returns to the VC, right? So you need to have the kind of mindset that are you prepared for that kind of responsibility, or do you want to act like the lone wolf and be your own boss? There's no right or wrong in this approach. It's essentially up to what you want, right? That's why you need to have that deep introspection within yourself, figure out what you want and then choose the right approach. If you take the VC money and then you figure out that I'm the kind of monitoring that which is being done, I'm not comfortable with that, and I don't like that, it's too late. So that's why it's extremely important to look at that beforehand and take the decision accordingly. And if any founder needs any help in terms of fundraising or needs help with growing the company, feel free to reach out to me. We'd be happy to help out. Thank you.
Thank you so much, Harsh, for sort of again highlighting the pros and cons of VC money. Thank you.
Thanks.
So, Gary,
Ooh,
Sorry.
go ahead, Kingsley. Why don't you go first?
Sorry.
just go with you.
Yeah. I hope Gary's okay. So someone should give him some water. Well, it's been another entertaining day, and I have learned a lot from this discussion today. We are all in a learning process. Nobody is perfect. Nobody has all the right answers to every question that is being asked today. We just have to keep on learning, and I advise funders to look into this kind of discussion platforms, whether it's Latokin, whether it's any other platforms that they can learn from. Life is a learning process. We all have our specialty. We all have our advantages and disadvantages as human beings, but being able to tolerate others is very important. The truth is, the world is becoming a smaller place with technology. I mean, we couldn't have done this 10 years ago, just 10 years ago. We have somebody from America, somebody from India, somebody from Singapore, so all over the world. So the world is becoming a smaller place, and we must now think broadly. How do we reach out to those in Africa? How do we reach out to those in South America? How do we reach out to those in Southeast Asia? Because we are one, and we cannot make it except we work together, and we have to learn to work together. So thank you all for today, and I look forward to another section on VCTV.
Absolutely. Thank
I'm
you.
ready now, Sonny.
Yes.
I'm better. So anyhow, it's a great time. Kingsley's right on target. The world is a smaller place because of the digital transformation. You got to look for where the money's open. Look for family offices, not only VCs. Look across borders in places like Dubai, where there's a lot of cash and people are interested in investments. But make sure that it's smart money and not dumb money, because it's not all about the money. It's about the expertise and connections that you're going to get from that particular investor. It's a great time. Data's around us and opportunities for all kinds of startups, especially in artificial intelligence, cybersecurity, quantum computing, to be able to make a dent in the universe and to solve a lot of the challenges that we have in front of us, whether it's global warming, increase in population, manufacturing, health tech. I just saw that Jeff Bezos invested in Altos Labs, which is changing the nature of how long we're going to live with some new kind of stem cells. So great opportunity out there. You can reach me, Gary Fowler, on LinkedIn. You can reach me on Twitter. Check out my show on VCTV, The Founders Report, and also GST Presents Silicon Valley AI and Tech. Thank you very much.
Thank you, Gary. Thank you very much. Vandana, over to you.
So, my closing thoughts are, it is important to remember that venture capital firms are also businesses, just like the companies they invested. While venture capitalists do want to help your company to be successful, they are really in the business of raising more venture funds. And venture firms are driven to build the most oversubscribed venture fund and make a lot of money doing it. However, a venture fund's business model is quite different from traditional businesses, and if you learn how venture investors make money, you'll understand what motivates the decisions they make while working with your company. So
Right.
I could be reached out on my LinkedIn handle and my website on www.convanto.com. We also help a lot of VC funds raise funds. We are helping 3 funds lately with these kind of arrangements as well. And we also help startups. So please feel free to reach out to us. And thank you for having me here.
Thank you, Vandana. Thank you, Harsh, Gary, and Kingsley. I learned a lot myself today, and it was extremely engaging and informative session. And I look forward to such sessions, such more sessions where we discuss new topics like we discussed this topic today, which is something that we live every day. Like, Gary, Vandana, you are like investors yourselves, right? So thank you so much for attending my show today. And I am looking forward to host you on another episode of VCTV. Till then, keep smiling and take care of yourself. And have a great day. Bye.
Bye bye.
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 Thank
Bye-bye.
you. Bye.
Stay safe.
See you.